We are back with another episode of Scaling Robotics. This is a series of conversations with leaders at robotics companies who have actually scaled their fleets, and we hope to democratize their hard earned lessons to benefit the next generation of scaling robotics companies. Today, we have an awesome guest here, Daniel. Daniel, thanks so much for taking the time. Do you mind introducing yourself?
Yeah, it's my pleasure to be here, Vidon. Thank you for having me. And I'm Daniel Kirstein. I am the founder of Holdfast Partners, which is a consultancy focused on financial and commercial infrastructure for robotics and hard tech. I didn't, start with Holdfast. I have a, kind of a longer history in robotics. I was the head of finance for Voyage Auto, which is an autonomous vehicle company that was acquired by Cruise. And kind of most recently on the startup journey was CFO of FarmWise Robotics, which was an ag tech focused company. I was also head of sales and head of procurement, as you wear many hats in the startup world. I've also spent time at digital media startup, at Google, at TikTok, which I left last year to build out Holdfast with the mission of really helping robotics companies scale and cross the commercialization chasm.
One of the reasons I'm so excited for your perspective is I feel like robotics is so nascent and not many folks are really thinking about kind of the bread and butter of what it takes to actually scale a commercialized fleets, what the financial stack looks like. And you and your experience, Daniel, I think have an awesome perspective there. Before we dive into some questions, especially on the kind of the robotics hard tech side, do you mind giving us some more detail about the companies that you've worked with, currently consulting for, share any stats about their scale or their deployments, anything for the audience to hear there?
So the Voyage was going back in time now, probably 50, 60 people or so, Series B company, and looking to scale actually with a really unique go-to-market plan on looking at retirement communities versus solving everything such as a Waymo. Instead, really narrowing the problem set to small, solvable geographies, which was a really smart way to scale. Didn't quite get there just given COVID happened and then the acquisition, but really interesting way to think about a go-to-market plan. FarmWise, I joined FarmWise. It was probably around about 25 people, just off the Series A, and I was brought in to help with the Series B. So we scaled that to, I think they had about 7 to 8 machines running a RaaS type service. Scaled it to about 14, 15, about 90 people, raised a 50 million plus Series B, kind of which was one of the biggest in the ag tech robotics at the time, but really kind of built that company up and helped them transition into a sales type model from the RaaS. So there was a bit of a transition there in how they went to go to market. Google, TikTok, obviously giants that people know, the digital media company, roughly about 250, 300 people. So seen scale and seen kind of that early stage scaling. Most of my clients today, though, are either, just starting out, couple founders and their pet dog in a garage kind of thing with an idea and some initial checks, to kind of a late Series A, Series B type that are looking to actively scale, go to market aggressively with the right plan and the right go to market strategy. So I really help them with fundraising, but also how to think through the market and how to aggressively approach that and maximize their utility there.
Maybe, zooming into the robotics companies that you did work at, you've been a finance person your whole career, right? You worked at a gamut of industries, but then you jumped into robotics and hard tech, specifically at Voyage and FarmWise, and leading finance there. When you first were thinking about joining as a finance role in robotics, what was your perception like, and what did it actually turn out to be operationally?
Yeah. Yeah, and I think this is just a parable about joining a startup in general, right? You go in on a finance perspective, you think, oh, okay, I'll do some accounting, I'll help out with some budgets and, help with some strategy. And given I'll be a lot closer to the product, maybe I'll have a little bit more of a say in how the company is run and help to influence, some good decisions from a finance perspective. And then you quickly learn that there's just so much more to do and there's so many more opportunities to get involved. At Voyage, I ran marketing. I did our community marketing. I used to put swag bags together and run community surveys. And like, I'm not a marketer, like, far from it, but it was a really interesting opportunity that I thought, hey, I'm interested. Why not raise my hand and go do it? At FarmWise, I joined and quickly became our in-house recruiter. for 6 months, as well as our HR lead, which I would not recommend for somebody that is not, qualified to be HR and recruiting. I have a lot higher, level of respect for those folks that run that role, just because it's really hard to do. But you really get to expand into it. Kind of mentioned in my preamble, like at FarmWise, kind of near the end of my tenure there, I was running sales, I was running procurement, I was leading HR in addition to finance, and so there was just a lot of opportunity to be able to really stretch out and to expand into areas that were interesting, were adjacent, but really where a company had a need. So when you go in and you think, okay, I'm going to do this role, the world's kind of your oyster, particularly with startups, to really kind of stretch out.
Yeah, I think that's a story of startups and a story of robotics, which is there's unlimited things to do, and just jump in and start solving some problems. Um, you hinted at this again with FarmWise that you were a RaaS model, right? Um, and you and I have talked about the different kind of business models that robotics companies can choose, and I'm sure at Holdfast you're consulting your clients around this. Can you talk us through some of the different business models that you see in robotics and some of the considerations that you see when choosing between the right business model for your business?
Yeah, I see it as really as three primary business models. There's the RaaS model, robot as a service, and I'll kind of go into why you would pick one over the other. Uh, but RaaS, robot as a service, you have a hardware sales model where you're selling the hardware up front, collecting cash kind of on day one, typically tied in with a post sales ongoing subscription package. You can dial that up or down depending on how you sell, i.e., low upfront cost, higher ongoing cost, or higher upfront cost, lower subscription. And then there's the third model, which is the has model, hardware as a service, with a close cousin being the leasing model. And there is a difference between has and leasing. Hardware as a service, you typically, if you kind of use car rental as an analogy, when you rent a car, you rent the car. You typically can maybe create a little bit of equity in it, but you get a car that you keep, and at the end of your lease, you give it back. That's it. That's the car that you have. For a has type model, you rent a car, meaning that this car that you have today, you're going to get another one. You're always going to have the latest and greatest depending on your package that you get, but it's kind of an ongoing subscription to cars in general, not the car that you're leasing. So a little bit of a different model, but similar in the sense that people will pay you monthly for the benefit of having your robot on site. So I view these three models as kind of the primary go-to-market plan for companies.
I think that's a great kind of setup. Maybe we can now go through those three and talk about like how you think about them. Maybe first we can dive into RaaS and how you think about that.
Yeah, absolutely. And if somebody came to me and said, "Hey, Daniel, I need some help figuring out how to go to market. Which one do I pick?" Because they all sound good and they all have their pros and cons. And I look at it from kind of a three-part perspective. There's the technological feasibility, there's the market feasibility, and then there's a commercial feasibility. And so, early stage companies, does your product work? Is it reliable? Can you take it out into the field, into a warehouse, onto the roads? And is it going to continue to work over and over again? If it doesn't, you probably need somebody with it at all times, and probably good for a RaaS model where you are paying an operator to be there with the machine. It's also good if the machine breaks, you can quickly take it out, and it's just it's a quick removal. So the client doesn't get too bothered by something they've integrated into their fleet. So when it's earlier stage on the technological feasibility, RaaS typically works a little bit better. On the when you look at hardware sales, has leasing, the machine typically needs to work because somebody's buying it and they're paying a lot of money for it. They're integrating it, they own it, or at least they have something that they're leasing. And this is just the stakes are a little bit higher. The other benefit, just to go back to RaaS real quick, is as you start to get your cycles in and as you start to get data, having a customer relationship where people pay you money changes the relationship and ups the stakes pretty significantly. So a RaaS model is great to start getting those reps in because you're going out there, you're getting the machine those reps. It's a low risk way for the customer, relatively low risk for you, but you're getting paid for it. So great way to get the machine reps while earning some money as well. For the market feasibility, so this is where you start to look at and say, okay, how is the market ready? Rather, is there market fit? Does the customer need to be educated on the value of the machine? If you're doing a lot of education, you're typically not going to spend hundreds of thousands, sometimes $1 million plus for a machine. So the RaaS model is typically a very low risk way to be able to kind of get the machine out there. They pay based on a deliverable. You're doing something per acre, per mile, per box, per pallet, etc. If you can't perform, you don't get paid. So really low risk for a customer to be able to utilize the RaaS system, the RaaS service. If you're doing sales, if you're doing leasing, this is good to understand, one, the education, but also what the industry typically, how they buy. Some industries like agriculture like to own machines. They like to lease a machine. They can do some service, but they typically like to have, it's standard with John Deere and tractors. You don't just have a service of tractors, you own a tractor, or you lease a tractor, you finance a tractor. It's standard. That is what the industry can bear. That's how typically you don't want to reinvent two wheels at the same time. uh, so you typically move to that type of model. And then it's the commercialization piece, and this is more relevant to the has type model. Typically with has, there's been a gap in the market because when you move to has, you create a new problem for yourself. You create a working capital gap because instead of getting cash up front, which is fantastic for hardware, you now kind of push that cash out over many years. And that's great revenue because it's financeable, it's ARR, investors, bankers love it. But now you don't get that cash up front. So you need to find a way to fill that gap. And when you do, you can spin this model, you spin that flywheel, you start making quite a bit of money, you get that kind of money back in, you spend it more, you buy more inventory, but you need to fill that initial gap. And over the last few years, there's been a number of equipment financing partners as robotics has matured, have started to wade into the sector and have started to provide financing where it's kind of been a gap before. So it's unlocking that model, but really is it commercially viable? And bankers are a bit more conservative, so they want to see contracts, they want to see the machine work. So it's usually a later stage type of model.
It sounds like, on the technological feasibility aspect, a lot of the reason to do an as a service model, specifically in RaaS, is just that the product itself is just not quite there to be standalone without continuous monitoring, continuous operations. Do you see the industry as, physical AI products mature and become more reliable, that moves into more of a kind of traditional hardware leasing model? And I guess if not, like what are kind of those reasons that RaaS might stay around even with really mature products?
Yeah, absolutely. RaaS has a place. There's different shades of each of the models, and certain industries, certain products just lend themselves to a RaaS model better than others. For example, Waymo. They're a typical RaaS model. Like, yes, one day you may be able to buy a fully autonomous level 5 vehicle, but taxi services will probably always exist in some form. RaaS model is going to be great, for many years, and for Waymo in particular. So it will exist in certain markets, but there's a few things that need to be kind of kept in mind with RaaS. And at FarmWise in particular, this is where we went really deep in our analysis as FarmWise was starting to scale and getting ready to kind of bring its new version of its machine out. In that, RaaS really works when the market is concentrated, when you have a large amount of customers, acres, warehouses, miles, et cetera, whatever your unit of measure is in a certain geographic area. As you think about expansion into different areas, typically founders are really good at picking the great spot to start. But as you start to think about other areas to expand to, the concentration starts to kind of thin out. So your net revenue per cost starts to kind of decline quite a bit. So at FarmWise, as an example, it was an ag tech. So a lot of agriculture in Salinas area, in Santa Maria, California in general, Imperial Valley, Yuma, Arizona, are some of the biggest leafy green growing areas in the world. Super concentrated, hundreds of thousands of acres, paradise if you're into the specialty crop sector. Great. FarmWise had a lot of traction and was growing pretty quickly. But then we started to look, a little bit further afield. How do we grow? How do we scale? And if you look across the US, even the world, those really concentrated growing areas started to get pretty sparse pretty quickly. So FarmWise had a choice of, okay, we could set up different operational areas across the country, but the kind of revenue per each of those operational areas will be at a lesser than what you're getting in the kind of the Salinas area, which was the king of specialty ag. So there's a cost component there as well. There's a margin component on scaling. So that's when you start to look at other models such as hardware. The machine was ready, technologically feasible, it could stand on its own. So there was some gaps to clear first. But you start to look at hardware around how do you start scaling without the infrastructure, without the heavy operations presence, without that ongoing support that's required for the machine, where you're able to activate channel partners, you're able to activate dealerships, really start to activate a variety of partners where you're able to increase the efficiency of your sales team. So this was analysis we ran, and the RaaS model actually won out when you look at the lifetime value of a customer, when you look at the overall revenue per customer over, say, 5 years. Where the hardware model wins, and it was particularly valuable to FarmWise at the time, is that initial cash coming in the door because you get a lot of cash on day one. And for a scaling startup, cash is oxygen, which is why FarmWise, one of the reasons that it moved to the hardware model. And margins in hardware are typically pretty good. You want to aim for 50, 60% plus. You do a post-sale subscription package, it'll probably start pretty poor on the margin side just because you're building for volume. But if you're doing mostly SaaS type support, you're looking at what, 70, 80, 90% plus margins versus RaaS, which will start pretty negative as you build up infrastructure to scale. But a good RaaS, is probably looking at 30, 40% margins with a strong lifetime value. So there is definitely a place for RaaS. It just depends on your market, how you scale, and the concentration of the overall market. And can you do it efficiently with, say, one operator to many machines to reduce that cost and increase that margin?
On the RaaS part, I totally agree. In the beginning, the margins are pretty poor, right? When you're first kind of setting that up. I actually, previously spoke with Saman Fareed on this podcast, CEO of Formic, and he mentioned it takes a lot of infrastructure and operational excellence to be able to run a RaaS model well. In your perspective, what are those other parts of the business that are outside? Maybe you can talk about the capital stack, but also other additional areas of the business that you might need in order to be able to run RaaS successfully.
Oh yeah, and that guidance is 100% spot on. At FarmWise, I mentioned we had about 90 people or so. Over a third of the company at kind of the service peak was operations support for roughly 15 machines. So you can do the math. You need operators, you need kind of spares, so to speak, when people call out. You need supervisors, you need techs, you need mobile techs, you need welders to fix things, a warehouse manager. Like, it's just a lot of stuff. And it really changes the DNA of a company. I think most people get into robotics, high tech. It's interesting. You're melding electrical and mechanical and software and perception and cutting edge and all this good stuff. And then you're like, I'm going to market. And how do I do that? RaaS is great. And I got to hire an operator, and I got to hire a mechanic, and I got to hire a welder. And depending on the industry, sometimes people are very polar opposite to the high tech culture that you're looking at, which is great, and it grounds you, and it creates but it creates a different DNA that you need to understand when you go to market, and it's overhead, and it's a warehouse, and it's all this stuff that companies often are caught by surprise, that they turn in from a high-tech operating company to just an operating company, and they're dealing with HR issues and payroll issues and all this stuff that comes along with the operating side. So it is an ongoing kind of thing to manage beyond just, I'm going to make some money and put my machine out in customers. So it does change the DNA, and I would argue oftentimes for the better because it grounds. But some people again are caught a little bit unawares by how much it can change.
Yeah, turns out just throwing AI at your robot doesn't necessarily mean that you can own and operate it and deploy it to farms and warehouses. Who would have thought? So one of the things that you mentioned was kind of one of the challenges of the has model was that the working capital crunch, right? You don't get all that cash up front, and cash is king in a startup. Can you just tell us a bit more about kind of what the hygiene needs to be for robotics companies to understand their working capital and cash, and how you think about situations like these?
Yeah, absolutely. And in my opinion, working capital is one of the cruelest ways to fail as a company because you fail through success. And what I mean by that is, let's say you had revenue of, I don't know, 5 million bucks, and you 5x'd, right? So you're going up to 25 million, which is a home run, and you're scaling and everything is great. But let's say you had $1 million of inventory, and that also needs to go up 5x. So you need $5 million of inventory, but you only have $2 million of cash. So you've signed all these orders, and now you have a gap, of $3 to $4 million. You're likely burning on payroll and lease and all this stuff as well. So how do you fill that, two, three, $4 million to cover your inventory costs, which may not be paid back for 6, 9, 12 months as you deliver on these orders? but the inventory might have a 6 months lead in time. So it's really a huge gap. You see it with HAS, you see it with sales, you see a bit with RaaS as you put that investment in on the initial kind of operating side. And being able to manage the capital stack kind of holistically is super important, particularly in hardware. And it's one of the reasons that, the proverbial saying hardware is hard, because you just have a full financial statement to manage. It's not just about the P&L and your churn and your margin percentage. It's also about your balance sheet and your inventory and likely your debt, and bringing on debt to balance out your capital stack so you're not relying on high cost equity. And then, filling that plug, using those signed contracts, getting deposits in early, getting, creative in a sense on how to bring that cash in. And those first few contracts, you may be leaving money on the table to bring kind of that cash in to get that flywheel spinning, so you can buy more inventory, so you can deliver more on sales, so you can buy more inventory, and on and on as you spin up. But it's always keeping in mind how much of the inventory will cost, what your ongoing working capital is, how much your payroll is each month, your vendors, etc., so that you aren't caught unawares, that you don't overextend yourself. And then if you do, you've built partnerships with lenders, venture capitalists, financiers, etc., that they're willing and able to get a facility up and running for you to fill the gap quickly.
In the first few deals that you're doing, uh, the number one thing to solve for is just get cash into the bank account as fast as possible. And it's okay if you have to take a hit on the deal size or may not have some terms that are favorable, because what you really need is to get the flywheel to start spinning, so that you can run this model effectively.
100%. It's both the flywheel spinning as well as just adoption in the market. One of the worst things you can do is go to market and price way too high and then just kill all kind of momentum and buzz, and people just, I don't quite understand the value, XYZ. And then it just slows down, and then you lose your beachhead, and then kind of your launch stalls. So you typically price a little bit lower. You leave some money on the table. You maybe take more cash up front at the expense of longer term deals to get the cash in the door so you can continue that march for more inventory and more scaling. So, there's many things, many levers you can pull. But yes, typically those for a few deals, is given the value is not fully ascertained by clients and customers. You just want to get those out there. You want them to demonstrate themselves. You want to have your customers be your biggest lighthouse, beacons where people can go to and talk and see the value, and on and on. I know that's a bit of a sidebar, but I think it is important as you think about going to market.
I think these things are also intertwined. So it's equally as important to think about the financials of the business as the actual market perception of your product. If I'm an early stage robotics founder, right, I think something I probably won't have is a lot of experience being able to accurately kind of forecast my cash needs at a high level. Can you talk a bit about what some of those building blocks and levers are as an early stage robotics founder that I should be thinking about when it comes to my cash forecast?
Yeah, absolutely. And forecasts in general, in finance, I'm biased, but I view annual budgets, longer range forecasts as not just exercises for your next fundraise. I view them as a unification process where you're just kind of thinking through the future, bringing disparate parts of the team together. Hey, sales, what does your sales forecast look like? What does the top line look like? How much inventory do we need to manage that burden? How much does it cost? Et cetera. What is our payroll? Can we afford more headcount? What does our runway look like? Really kind of getting together, thinking through that, and then tying it into the overall strategic roadmap. It is a fantastic exercise. Again, just one of the few that unifies a company in a very quantitative way. Having said that, the moment you finish a forecast, it's wrong. So, but the value is in the exercise itself and building it. And you can keep it updated, but continuing to manage it, continuing to check in with it, continuing to just see, are we on track? And if not, if things have changed, as they often do in early stage startups or just companies in general, you update it on a quarterly, half, semi-year basis. So I view that as just an existential exercise. And the sooner you start to put that into your DNA and start to collect and connect the disparate parts of the company into one cohesive document, the better are you, kind of managing that cash, the better your DNA is to manage the cash flow and your cash burn. So I think that's really important. The other piece is starting to develop relationships with VCs, important, equity is important, particularly early stage startups, but also bankers and financiers. There's a number out there, from your typical standard banks, but also the equipment financing world is probably 5 to 7 players. And they all have different underwriting terms. They all have slightly different terms of their debt. Some may be a fit, some may not. but it's great to build relationships, to get to know them before you need them, because they build a baseline comfort with the company, and they tend to be pretty conservative, but relationships really matter. So the longer the relationship, the more trusted it is, the earlier it starts. Instead of you going hand in hand and saying, I need some money desperately because I need to fill a working capital gap, they understand, they've been building up to it. It really sets the stage. It's that proverbial saying, dig your well before you're thirsty. It really extends here to finance and financiers and bankers. So something that I encourage all founders to start with, even if you don't feel you need debt, for the near term future.
Yeah, and from a meta point, something I think I hear is canonical startup advice is to try to avoid debt and raise equity as an early stage company. Hardware and robotics, the rules are a lot different. Can you maybe take a step back and talk about why debt is such an important kind of instrument when you think about the capital stack for a robotics company, and in general what these robotics founders might be missing in terms of their capital stack that they're assembling?
Yeah, definitely. And equity is great, and it's the capital you typically need to get off the ground. Though some do and are very successful at getting grants. So grants are typically non-dilutive. They're out there, highly recommended if you can get them. It can take a little bit longer, lots of paperwork, but it's great capital to get started. Equity is typically next, and then once you have some equity, particularly once you have some product, some customers, debt becomes a very viable financing arc for you as a company. And debt is scary. It's very scary because you have a commitment to a bank. You have to pay, X number of dollars a month, quarter, year, balloon payment, depending on your agreement. It can have interest rates that can feel astronomical sometimes, 15+%. And but having said that, debt is typically still cheaper than equity, and it does come with strings, and it feels real, and it is real. And in the wrong hands and the wrong time and the wrong application, it can absolutely kill a company. But when applied correctly, when applied conservatively, when applied with a use in mind, i.e., buying inventory to make more money, they can be, massive leverage that can create exponential returns for a company. And then once the debt is paid off, it's gone. Unlike equity that will stay on your cap table until you have a liquidity event, and then you're sharing the proceeds with that equity, which is why equity can typically be more expensive. So the consequences are absolutely real. It can be a bit hard to get, particularly as an early stage scaling company. But once applied and once eligible and once applied, it can be, again, that exponential return on that capital application. So highly useful, particularly for a hardware company.
When do you see companies you've worked with, hardware companies, actually start to look at debt? Is this something that happens as early as seed? You said, once you have customers and real growth. When do you usually see folks start to look towards that direction?
Yeah, so some founders, particularly ones that have been around a little bit, they'll look to start diversifying their capital stack when they make their first raise. So there's a few banks that will lend venture debt, and there's a ratio of about 1 to 5, 1 to 4, meaning $4 of equity raised, they get about $1 back in debt. Smaller notes, probably $1 million, $2 million, but it's term debt, it's 2 to 3 years, it's pretty simple, but a good way to diversify the capital table and just extend that runway out a little bit, particularly in the early years. Corporate debt, use it for what you want. So that's an application. You typically see it around the fundraise time. Seed is fine. Then you start to see the real application of debt once you start getting clients. RaaS, has, or hardware sales all are eligible for debt. But once you have those signed agreements, once you have a bit of a track record, equipment financiers start to get interested in what you're doing, because particularly if you have a post-sale subscription plan or has, which is really financeable, and a prime revenue, the ARR is typically much better than one-off sales. uh, Bankers are more than happy to lend on that because the risk has been mitigated, because there's now a signed contract and there's another party. It's not just your asset. It also mitigates the risk of your product, because when you're, have a prototype in a garage or a warehouse and it's not really viable yet commercially, the bank doesn't know what they're getting as collateral, and they do care about their collateral. When it's commercial and it's working, the bank has quite a bit more comfort into collecting something. At the end of the day, this is now a commercial product. So typically when you start scaling, when you have a fleet out, after there's a little bit of kind of track record, the banks will typically start lining up. And then once you hit profitability, particularly once you're scaling past the $10 to $15 million kind of annual revenue run rate, when you again profitable, potentially 1 or 2 years, now you can start playing with the bigger banks, and then you can upsize your debt to tens of millions of dollars. But most aren't there yet. So usually it's the equipment financing and kind of that term debt on a fundraise.
You said, one of the best uses of debt is when you have customers who want your product and you need to finance inventory to build that product and ship that product and support it. Um, what are some of the traps that you see, some of the not so smart uses of debt for robotics companies or places where you say, actually, hey, maybe avoid using debt there, think of a different way to approach this problem?
Yeah, so debt, again, in the wrong hands and the wrong application can be lethal. And here is it's using debt without a plan. So it's funding the company's general operations. And that's okay, if it's an extension of a round, if you are clear-eyed as far as the repayment terms and it matches potentially with another fundraise. Most term debt has a 2 to 3 year life, which typically tracks with most startups are raising about 18 to 24 months, given their next round, particularly hardware companies. If you know you can raise within that time period, repay the debt or refinance it, because likely you got a bigger round of debt, you're typically okay. If you're taking extractive debt, sometimes it's 20% plus because you're desperate. It's, short term, it's the balloon payment, when you don't really have a use for it that will generate money, you're just kind of papering over your expenses. That's where things can get pretty bad pretty quickly. And, so I would just go in clear eyed on that. Like, what is the use? Do your timelines match? Are you able to collateralize it appropriately? And if you can't, I would probably explore other options. If you have a strong investor base that is supportive, potentially you get some convertible debt through your investors. Potentially there's a bridge note, a safe, something like that to bridge you to the next round. There's usually options out there if the company's strong and progressing. And again, equity is expensive, but if the debt doesn't align, you lose that lethality piece of it. So, which is obviously very important.
Yes, survival is everything.
Yes.
You also said, you want to build good relationships, right, with your financiers, specifically like building early relationships with the equipment financing folks. I've never raised any debt. What do those kinds of investors look like? What do they look for compared to someone who's making an equity investment? What should robotics founders know there?
Yeah. So bankers typically are a bit more conservative. So, depending on who you're talking to, again, some different verticals, different risk tolerance and appetite, but as a rule, typically more conservative. So they, will want to see financials. Same with VCs. They want to see financials. They want to see tax returns. They want to see a forecast. All good, but they'll also want to understand the application of cash in a very kind of robust way. They'll understand the TAM, the SAM, the SOM, the business model and stress test the pricing, maybe a little bit deeper. Where they also really want to understand are the unit economics and in particular the collateral, i.e., what are they going to get back if the loan goes south? And for a robot that might be early stage, immature, they want to understand, okay, what that maturity path looks like. And they're not investing so much in the future, i.e., future returns. They're investing in how do they get the collateral back of the money they're putting in today. So it's really kind of a deeper dive on that. And the client contracts often talk to customers and understand, not so much are you going to grow with this company, but are you actually going to pay? Are you going to pay them back? What is your credit risk of the customer now? So it's really centered around that collateral and return on the debt. Some banks are a little bit more forward focused on risk, so they'll have more tolerance and they will look kind of more future because they want to build the relationships. And those are the best bankers to work with because they do absorb some of that risk for you. But again, general rule, more conservative, looking at collateral and how they get paid back today, not tomorrow, which is more of the VC outlook.
At Holdfast, you're working a lot with early stage companies and helping them nail their fundraises. We talked a little bit about what it takes to raise debt for robotics companies. Maybe we can look now on the equity side of things. Um, Raising for a hardware business, specifically a robotics business, is a whole different beast, right, than raising for software. Uh, what are some of the big things that you're thinking about with your clients on what we want to be driving home with these VCs whenever we're raising our early stage rounds?
Yeah, absolutely. And VCs for robotics, for SaaS, are going to look at very similar things for some things, right? As mentioned, same with debt. Like they're going to look at financials, they're going to look at some basic compliance stuff, look at a financial model, they're going to want to talk to people. Like there's some basic stuff that they're going to be looking at. They're going to pressure test pretty heavily on TAM, SAM, and SOM just to make sure that you have you understand the problem, you understand the pathway, and that if you have transferable IP, that it makes sense. If you say, "Oh, I'm in the ag tech space, but I'm going to transfer over to defense or construction or mining or all of them," can you actually do it, or is that just hand wavy? I'm going to expand my TAM really big and make me sound like a multi-billion-dollar company versus my actual problem set is actually 25 million. So they'll push pretty hard on that, the go to market, the different models that you're using, the capital, working capital, the cash burn, all of that. Where I advise hardware founders to really lean in though is the show, not just tell. And what I mean by that, at FarmWise, for example, we had a really interesting piece of technology that our CTO brought up and developed, and it was basically an integrated, we call it IPS, integrated plants scanner, and it was onboard camera, embedded compute, multispectral, stereoscopic, like fantastic lighting, all in one kind of shoe box type form. And you can talk about it on a slide and you can say how wonderful it is and what an amazing advancement. But then the CTO would walk in with this box and everyone would be like, wow, like it exists. And they would look at it and, turn it upside down and look at the cameras, and it would just create a really rich conversation. Then we would lead folks out either to the field to have the machine kind of demo in the field, or to a standing rig out in a warehouse, and you could see the image recognition, you could see the lights flashing. It's really a show, not tell, and it gets people really excited to see the machine in action. It demos as well in the ag tech space as a company that uses lasers. They use a really kind of interactive demonstration where they shoot kind of the lasers onto wood chips and the wood chips catch up in flame. And it's just really kind of visually arresting. It's all, tends to draw a crowd, and it's just really kind of leaning into that strength of, hey, this is a robot. This is really cool. This is something to be excited about, and it works. So yeah, I would say lean into that show, not tell. Software, it's easy to show, demo on your phone, on a presentation. You can do that with hardware, with a video, but it really reduces that kind of strength and the unique differentiation of having hardware and something that's tangible you can touch and see, with your own eyes. So that's what I recommend beyond, of course, the basics and TAM, SAM, and financials.
It's a good reminder. Everyone is just still human at the end of the day, and if you show someone a cool robot, they're a lot more likely to be excited by it than some random B2B SaaS. And so, if you're building something cool, why not just show it off? Show it off in person.
And most of the investors in the space love robots too. Like they are, really fans of the sector. They, the ones that specialize in it. They probably play with robots and, kind of built things as kids. Like there is a kid at every heart, as far as robots, and it tickles something in the people that love it, and they just love to see it. And it just, again, really uniquely differentiates hardware robotics companies from companies that don't have hardware.
For robotics companies specifically, I think physical AI is kind of having its moment in fundraising, right? We're seeing all these kind of physical AI labs raising a lot of money. We're seeing physical AI adjacent kind of application companies do the same, like in different vertical robots. Um, I think the promise is all there, right? It makes sense. Like these markets are massive that they're after. What are investors usually pushing back the most on? Are they thinking about, hey, can this technology actually work in production? How expensive is it to run hardware businesses? What are some of those blockers that you commonly see with the companies that you work with who are raising?
Yeah, and it's kind of back to that three-part framework, right? The technological feasibility, the market fit, and the commercialization. And I think as robotics, and as a rule, is beyond the technological feasibility place. Like we have advanced beyond that. Robots work. Sensors are coming down in cost. It works, right? So I think large part investors are understanding that, hey, things are working. You do your due diligence, but there's not as much pressure unless you're doing something incredibly unique and novel. Where they tend to press a little bit more is the market fit. So they want to understand that your solution, let's say you're building a humanoid that's going to be in every home in America in the next 5 years, doing what? So where's the value? So can you speak to, this is what why a consumer would pay $50,000 for this robot? What is it replacing? Are there substitutes, i.e., labor, parents, people that live in the house where they can not have to pay that much money and things still get done. So really pressure testing that market fit. And then the last piece, I think investors now, as the technology has started to become mature, is there a commercialization path? How are you commercializing? Back to the working capital piece. How are you funding this? How are you pricing this? You know, again, back to substitutions. Robots, in large part, replace hands, so to speak. Right? Yes, there's labor shortages. Yes, labor is often aging out in critical sectors. Input costs are rising. Regulatory costs are rising. That's all well and good, but if you have a robot that has to be charged out at, say $200 an hour, and there's a human substitute that can do it for 50, how are you ever going to get traction, right? What else are you offering beyond that? And oftentimes there might be yield increases in addition to, say, cost decreases, but really having that story buttoned up, not just, hey, I have a robot, it's really cool, it can do automation and it can work 20 hours a day. But if the cost just doesn't match, the unit economics just doesn't jive with the value the customer is getting, that is really important. So the pivot is starting to move away from tech into the commercialization, into, does this make sense? Are your unit economics strong? Can you fund this? Is the market ready? Which, again, good problems to have as the sector as a whole starts to mature.
Daniel, this has been an awesome conversation. I think like there's so much information about how to run the finance side of the house, in general, the commercial side of the house that robotics companies need to know as they scale their fleet. So this is very helpful. Yeah, I have a few more questions in closing before we let you out. Uh, First, what advice would you leave to robotics founders who are about to scale their first fleet of robots?
Yeah, probably the core piece of advice that I would give founders is to really understand your customer. And that takes a lot of on field, on warehouse, in warehouse, on road time, and understand their core problems and really become a product that has a solution to their problem, not a solution looking for a problem for them that they may not or may have. So really understand that. And it takes time, it takes effort, it takes energy to be able to do that. But by getting those learnings, by bringing them back, it helps inform your capital stack. It helps inform your go to market model. It helps inform the team you ultimately assemble, the investors you bring on, the debt partners. All of it starts with the customer and the ultimate value that you're providing them today and tomorrow. So understand that customer, probably core advice. And unfortunately, people tend to look past it.
Yeah, it's the most important thing, right? If you don't love the customer and solve their problems, everything else you do in the company is moot. Um, Speaking of loving customers, what do you love about the clients that you work with? Why do you build your company in hard tech and robotics? What makes you so attracted to this kind of corner of the world?
If I could pick one segment to spend the rest of my career in, it would be robotics. Like, I think we were at the precipice of what I call the personal robotics revolution. Like, robotics have been around for a while in factories, warehouses, behind closed doors, but we're just going to see a massive proliferation of personal robotics in roads, in our homes, on our fields, at the shops, and sidewalks, etc., where there's no longer just science fiction. And I think it's just incredible. And it's going to be a massive productivity boost for the country. And I think no better place to be, just given the unification of so many disparate parts of technology. So I'm all in a robot. I think it's a fascinating, wonderful sector. And I really enjoy working with founders that are building towards this future and bringing those ideas and bringing that energy. It gives me a lot of energy, and it gets me out of bed in the morning. And yeah, I love it. So that is the reason I founded Holdfast, is to get closer to that, to be closer to that inflection point, and to work with these really brilliant people and help them scale a lasting business.
I love that. I couldn't agree more. I think we're on the precipice of something special in robotics. Uh, Daniel, thank you so much again. Before we leave, is there any way the audience can help you? Feel free to make any shout outs or calls to action.
Well, thank you. Yeah. So, if you're a seed through Series A, B founder looking to scale, looking to raise, you're who I would like to work with. Robotics companies, hardware, automation. Um, Always happy to have a call. I also write about robotics on Substack, Robotics CFO. Always appreciate commentary and feedback. But thank you for having me. It's been wonderful to chat, and thank you.
Yeah. Thanks for taking the time, Daniel. Yeah. Couldn't recommend Daniel's Substack more. Robotics CFO. It's awesome. And definitely check out Holdfast Partners if you're in that C to Series B in the robotics and hard tech world. Daniel, thanks again for taking the time. This is a great conversation, and we will see you later.